Hi everybody. The last couple of weeks have been key from a US economic data perspective. So I just want to give a quick update on the implications for investors. So I want to focus on two key data releases. The first is the employment report at the beginning of the month, which suggests that net job creation is off the charts. And then this week we had inflation data which came down marginally in year-on-year terms, but was higher than expectations and actually accelerated month on month. Now these data points have increased the narrative that while the Fed has more work to do, the chances of achieving a soft landing have increased. Now I agree with the first conclusion, but believe this reduces the likelihood of a soft landing in the coming 6 to 12 or even 18 months. So let's start with the Fed. Given that the US economy at face value looks stronger today than it did a month or two ago, and the fact that inflation is showing signs of being stickier, we believe it's going to be increasingly difficult for the Fed to pause its rate hiking cycle. We expect 1 to 2 more 25 basis point rate hikes before the Fed pauses. And given the FOMC schedule, that would imply that Fed will only pause from the May or June meetings. Of course, if growth and inflation data continue to surprise on the upside, then the risk is that rates go even higher than our forecasts. Now, I believe there are two problems with this. First, the yield curve inverted in October, suggesting the Fed had already tightened too much, at least as far as markets were concerned. Since then, the Fed has increased rates by another 150 basis points, and as mentioned earlier, we don't believe they're done yet. The second problem is, what if the backward-looking data being focused on dramatically overstates the strength of the US economy? Business confidence and consumer data and the yield curve are all pointing to a heightened risk of a recession in the coming months. The one area that has held up reasonably is the other data I want to talk about, the labour market. Now, on the 2nd of February, we saw the strength of the labour market seemed to be reaffirmed by the strength in non-farm payroll. The net job creation number came in at over 500,000 jobs that were being created in January, compared to an expectation for this to be less than 200,000. However, some interesting analysis by our research colleagues cast doubt on the accuracy of the employment report and its usefulness when measuring the strength of the labour market. Now, it's important to remember that the employment report is a survey, and the composition of respondents can change on a monthly basis. However, our research colleagues highlight a huge discrepancy between this survey-based estimate of job creation and the quarterly sense of employment and wages, which should be more accurate. Now, without getting too much into the weeds, the BLS has to make an assumption on how many companies closed their shutters and how many opened their doors when it comes to assessing the likely net job creation on a monthly basis. In Q2 last year, the BLS data assumed a net 670,000 jobs were created by companies opening for business after subtracting the jobs lost by businesses closing down. The census data, which should be more accurate, counted just 25,000 jobs, or 96% less than the BLS estimate. Our research colleagues posit that something similar, maybe not to the same extent, is likely to have been repeated in Q3. So what does this mean for policymakers? Well, in the short term, to be honest, probably not a lot. They clearly have a bias to ensure that inflation comes back towards target rather than worry excessively about growth at this stage. What it does mean is that the Fed is even less likely to achieve a soft landing in this cycle than is increasingly the narrative in markets. Now, clearly this has implications for investors. 3 weeks ago, we started flagging that financial markets were showing increasing signs of groupthink, which raises the risk of a short-term reversal of the recent prevailing trends, or at least a consolidation. Now, since then, the US dollar and the US 10-year government yields have bounced back, while gold and Asian equities have fallen, both reversing the previous trends. And obviously this happened amid a consolidation in global equities. Now, going forward, these corrections may continue into the near term. However, given our fundamental outlook, we would continue to look for yield spikes to increase exposure to bonds and multi-asset income strategies, and we would avoid chasing the rally in developed market equities higher. And like I say, that's against the backdrop that we still see a recession as being likely in the coming 12 months. We would also look for opportunities to fade the US dollar rally that we've seen recently and add back to Asia ex-Japan and China equities. So that's the sort of implications we see of these two main data releases. So we're still consistent with this view that Asia will outperform and bond yields will come down. Please keep an eye out for our updates on our Standard Chartered Money Insights podcast channel or our Standard Chartered Wealth Insights pages on either LinkedIn or Facebook. Clients can also access our latest views on the SC mobile app. Meanwhile, thank you for taking time to listen to this video, and I hope you found it useful. In the meantime, wishing you well, and please take care.